if an RSI reading above 70 actually meant sell, and like a reading below 30 actually meant buy.
Everyone would be rich.
Right. I mean, every 18-year-old with a brokerage app on their phone would just be trading from a private yacht right now.
Exactly. But they aren't.
No, they are not. Mostly, they're just, blowing up their accounts.
Yeah, getting totally wrecked.
Because we all want this easy button, right? When we look at a financial chart, whether it's, your retirement portfolio or some crazy volatile crypto asset, we just crave this simple red light, green light system.
Oh, absolutely. I mean, it's just human nature to look for certainty in a totally chaotic environment.
Yeah.
We basically want a mathematical formula to take all the emotional weight off our shoulders. Like, just tell me when the top is in, tell me when the bottom is in.
Right. And a lot of beginners, and honestly, maybe even you listening right now, are taught that this indicator called the RSI.
Relative Strength Index, yeah.
Yeah, the RSI is supposedly that magic formula. Like day one of trading school gives you this painfully simple rule. Mm-hmm. If the line crosses above 70, the market is overbought, so you short it.
Right.
And if it drops below 30, it's oversold, so you buy the dip.
Which is incredibly dangerous.
So dangerous. And that's why, welcome to this deep dive. Today, we are pulling from this really fascinating guide titled Mastering RSI Momentum. Advanced Strategies for Professional Trading.
It's a great source. Really breaks down the mechanics.
It really does.
Yep.
And our mission today is to completely tear down those dangerous, account-destroying beginner myths about the RSI. We're going to explore 3 highly counterintuitive techniques that actual professional traders use.
Yeah, to do that, though, we have to start with a massive paradigm shift.
Okay, lay it on us.
Well, we have to totally strip away this idea of the RSI as a crystal ball for predicting tops and bottoms.
Right. It's not a fortune teller.
Exactly. It is not a price prediction machine. It's a gauge of momentum. It measures the raw speed and the physical strength of the cash flow behind a price movement.
So if price is like a car moving down the highway, the RSI isn't a map telling you where the road ends.
No, not at all.
It's the tachometer. It's telling you how hard the driver is mashing the gas pedal, or if they've, taken their foot off and the car is just coasting on inertia.
That's a really great way to visualize it. I mean, a trader who only looks at the price action just sees a vehicle moving forward.
Right.
But a trader looking at the RSI sees the engine. They see if the buying power fueling that upward movement is still fiercely strong, or if the tank is practically empty.
And the beginner's view of the RSI, they just treat it like a simple household thermostat.
Yes. Like, it's at 70, it's too hot.
Right. The AC is absolute guaranteed to kick on and the price will drop. Or 30 is too cold, the heat will turn on, price rises.
Which is it's fundamentally flawed.
It is. So today, we're taking that thermostat off the wall. We're going to learn how to use the RSI like an X-ray machine.
I love that analogy.
Yeah, to see straight through the price action and watch what the massive institutional players, the smart money, are quietly doing behind the scenes.
And that X-ray is actually going to reveal our first advanced technique.
Yeah.
Because relying on that rigid thermostat approach is the fastest way to get trapped by market makers.
Oh, for sure.
We need to look at what happens when the price on the screen and the momentum in the engine completely decouple from each other.
The lie of the higher high.
Exactly. We need to talk about divergence.
Right, divergence. So for you listening, this is the concept where the price of an asset and the momentum of that asset are actively disagreeing with each other. They're basically splitting apart.
Yeah, and the trap for new traders here is believing that price is the whole story. I mean, price is just the receipt of a transaction.
Well, that's good.
The RSI shows us the actual effort it took to print that receipt. So let's break down bearish divergence first.
Okay, what does that look like on the chart?
Well, this happens when the price of an asset continues to push up, like it physically makes a new higher high on the chart.
Right, the line goes back.
But the RSI, or momentum gauge, it drops. It actually makes a lower high.
So the price is visually higher, but the underlying buying power is dying off. Let's get into the mechanics of that, because the source material points out that this is exactly when market makers are distributing their assets.
Yes.
Like, how does that actually work behind the scenes?
Okay, so think about the logistical nightmare of being an institutional player with, say, hundreds of millions of dollars of an asset to sell.
Right. You can't exactly just log into a brokerage app and hit sell all.
Exactly. You can't just dump that all at once on the open market. If you do, the price will instantly collapse and you'll completely destroy your own profits.
So what do they do?
Well, to sell a massive amount of supply, you need a massive amount of demand. You need liquidity.
You need buyers.
You need a frenzy, honestly. You need retail traders just foaming at the mouth to buy.
Oh, wow. So you need them desperate.
Completely. So the market makers basically let the price push to a new thrilling high. They absorb all those frantic retail buy orders, quietly handing over their heavy bags of the asset.
While everyone else is cheering.
Right. And the price is still creeping up because of the sheer volume of retail FOMO, fear of missing out, but the massive, heavy institutional cash flow that drove the original trend, that's gone.
The momentum drops.
Yeah, the RSI plummets while the price hits a peak.
The guide actually uses a really stark example from the crypto world that paints this perfectly.
Oh, the Bitcoin example.
Yeah. So picture Bitcoin hitting a brand new all-time high.
Yeah.
The price is going parabolic.
Yeah.
Social media is losing its collective mind.
Everyone's a genius.
Exactly. Everyone is euphoric, and retail traders are aggressively buying in because they're absolutely terrified of missing the boat to generational wealth.
But if you look at the X-ray,
Right. The RSI is actively sinking. It's like pushing a heavy boulder up a hill. The boulder is still moving upward, but the amount of physical force the pusher is applying is rapidly dropping.
and the moment they stop pushing, gravity takes over.
The professionals see that the engine is dead. And as the text points out, a massive violent crash usually follows right after this phase.
Yeah, and we see the exact inverse play out at the bottom of a market too, which is bullish divergence.
So that's the flip side.
Right. The price is crashing, making lower lows. The chart looks absolutely terrifying.
Blood in the streets.
Exactly. But the RSI starts making higher lows. This tells you that, yes, the boulder is still rolling down the hill, but the actual panic selling is drying up.
The selling pressure is exhausting itself.
The institutions are quietly absorbing the panic, just accumulating assets at a deep discount while everyone else is capitulating.
Okay, wait, I have to push back here. Because if I'm sitting at my desk looking at a chart and I see the smart money moving, like if I see the price making a lower low but the RSI making a higher low, flashing this bullish divergence,
Yeah.
shouldn't I just smash the buy button right that second? I mean, if I see the X-ray showing the exhaustion, why not jump in immediately?
Because jumping in immediately is how you catch a falling knife. Divergence is an early warning system. It is a flashing yellow light on the dashboard. It is not a green light to floor the accelerator.
It's interesting.
Because in a deeply entrenched, highly emotional trend, a divergence can last a painfully long time before the market actually reverses.
Like days, weeks.
Sometimes weeks. You might spot a bearish divergence, proudly sell your position, and then just watch the price grind upward for another 3 weeks on sheer irrational exuberance.
Oh man, and you're just sitting on the sidelines watching everyone else make money, feeling like the indicator completely lied to you.
But it didn't lie, it just warned you early. That's why professional traders never, ever act on divergence alone.
What do they do instead?
They use it to prepare their strategy. They basically sit on their hands and wait for price structure confirmation. They wait to see volume actually increase in the new direction.
Okay.
Or they wait for a clear, undeniable breakout at an established supply or demand zone. Divergence tells them the fuel is low.
But price action proves the engine is actually stalled.
Exactly.
Okay, so divergence is the warning light. And we know it can flash for a long time before anything happens.
Right.
But if that's the case, how do we use the RSI the rest of the time? Because markets aren't always reversing.
No, most of the time they're trending.
Right. Most of the time, they were just cruising along.
Yeah.
So what is the X-ray telling us then?
Well, this brings us to a massive psychological hurdle, and it's the second major technique in the guide. Reading the RSI by context, not by rigid numbers.
Oh, this is huge.
We have to confront the paradox of overbought.
And this goes right back to that mechanical beginner switch we talked about at the start. That rigid idea that 70 means sell and under 30 means buy. The text makes it incredibly clear that this exact mindset gets people utterly wrecked.
It liquidates accounts daily.
Yeah.
Because here is the great paradox. In a strong, established uptrend, an RSI reading over 70 is actually a bullish signal.
Wait,
It is not bearish.
I really want to underline that for anyone listening because it violates the very first rule everyone learns.
Yeah.
An RSI over 70 in a strong uptrend means the market is bullish.
Yes, it means the cash flow is aggressively strong. The buyers have absolute control.
Okay.
But a novice gets trapped in that overbought mindset. They see the RSI hit 72, they assume gravity has to take over, and they short the market, betting it'll drop.
Right.
But let's look at the mechanics of what happens next. The price keeps rising. The RSI hits 75.
Oh, no.
The novice's short position is now severely underwater.
It's like looking at a massive freight train barreling down the tracks at 100 miles an hour. You look at the speedometer, you see the dial is pegged high, and instead of saying, wow, that train has a terrifying amount of kinetic energy, you say, well, the dial is high. It's definitely due to instantly reverse backward right now.
Exactly. Stepping in front of an RSI of 75 to short it is literally stepping onto the tracks.
That kinetic energy analogy is perfect. And the brutal reality of what happens to that novice trader only adds more fuel to the fire.
Well, it gets worse.
Because as the price pushes higher, those retail short sellers are forced to cover their positions to avoid losing everything.
Right, and covering a short requires buying the asset back at market price.
So their failure literally forces them to become buyers.
Yes.
Which shoots the price even higher. It's a classic short squeeze.
A textbook short squeeze. The retail traders trying to catch the top end up providing the exact liquidity the market needs to keep going up. Wow. Context is absolutely everything.
So if 30 and 70 are a trap in a trending market, what do the numbers actually look like in a real healthy uptrend?
Well, in a dominant uptrend, the buyers are so aggressive that the RSI rarely even sniffs the 30 line. A healthy trending RSI actually floats between 40 and 80.
Between 40 and 80,
yeah.
Okay.
And when the RSI pulls back to the 40 or 50 range, the beginner panics and thinks the market is crashing.
Right.
But the professional recognizes that pullback as the market just catching its breath. It's a premium opportunity to buy the dip and ride the continuation of the trend.
So flip that upside down. If I'm watching a market bleed out in a downtrend and the RSI drops into the 20s, I shouldn't buy.
Nope.
And if the RSI tries to recover but gets aggressively rejected at the 50 or 60 level, that's not a recovery at all.
Not even close.
That's a dead cat bounce. The buyers are too weak to even push the momentum gauge back to the top half of the spectrum.
You've just identified the most critical filter professionals use. Beginners ignore it entirely, but the 50 line is the true battleground of the RSI.
The 50 line.
Is the equilibrium point.
Like a constant tug of war.
A literal tug of war. And professional traders use that 50 line as their primary trend filter. If the RSI is consistently holding above 50, like bouncing off at a support, momentum fundamentally favors the bulls.
The buyers are winning the tug of war.
Exactly. If it's constantly trapped below 50, getting rejected every time it touches it, the bears control the market. You don't read the indicator in a vacuum.
Right.
You combine that 50-line context with the overall trend on the chart, maybe an indicator like a 200-period moving average, and an understanding of market liquidity.
Okay, so the 50 line shows us the tug of war. We can see who is currently dragging the rope.
Yeah.
But just watching a little flag hover near the middle doesn't give you a massive edge. You need to know the exact microsecond the other side's grip starts to slip.
Now you're thinking like a pro.
Which brings us to the third, and honestly the most unconventional technique in the guide, drawing RSI trend lines.
Yeah, this is a technique most retail traders will literally never be taught. Yeah. Normally when you hear trend line, you think of the price chart. You know, you take a digital ruler and connect the higher lows of the green and red candlesticks to see the upward angle of the price.
Right. Let me make sure I'm picturing this right, though. The guide is saying to ignore the candlesticks entirely for a moment.
Yes.
You go down to the bottom of your screen where that squiggly, jagged purple RSI line is fluctuating, and you draw your physical trend lines connecting the peaks and valleys of the momentum indicator itself.
Exactly. You treat the RSI line with the exact same respect you treat price. You connect its structural highs and lows.
Wow.
And the underlying logic for why this works is foundational to everything we've uncovered so far. Market makers leave their footprints in the momentum before they ever show up in the price.
Because the effort happens before the result.
Yes. Because a shift in cash flow happens before the receipt is printed, the RSI will actually break its trend line before the physical price breaks its trend line on the chart.
That is an unbelievable, unfair advantage.
It really is.
Think about the timeline of how a trade usually plays out, right? The beginner retail trader is sitting there, nervously staring at the candlesticks.
Sweating it out.
Yeah. They're waiting for the price to break above a major resistance level before they feel safe entering the trade. And by the time the price finally pushes through, it's glaringly obvious to everyone on the planet.
The retail crowd FOMOs in.
Right. But the professional who drew a descending trend line directly on the RSI, They already saw the momentum shift break upward, like 3 candles ago.
The big money was quietly positioning.
The professional is already safely in the trade, just comfortably waiting for the retail crowd's delayed reaction to push the price up into profit.
It is the difference between reacting to the evening news and reading the telegraph wire before the newspaper is even printed.
Oh, like that.
You are trading the cause, not the effect. And the text builds to what it describes as the ultimate setup.
The grand finale.
Yeah, it's the rare moment when all of these individual X-ray techniques align perfectly into one clear narrative.
Let's walk through that narrative. What does that perfect storm actually look like, step by step?
Okay, picture a chart that has been in a brutal, extended downtrend. Everyone is bleeding.
Okay, got it.
Step 1. The RSI plunges deep under 30. We are in extreme oversold territory. The panic is palpable, and the weak hands are capitulating.
So total fear.
Total fear. Step 2. A bullish divergence materializes. The price pushes to one final agonizing lower low, but the RSI makes a higher low.
The boulder is still rolling down, but the pusher has given up.
Right, the heavy institutional selling pressure has completely exhausted itself.
So the fuel tank for the crash is definitively empty.
Exactly. Now, step 3. You've drawn a downward trend line across the peaks of the RSI over the last few weeks.
On the indicators.
On the indicator. Suddenly, the RSI breaks violently above that line.
Boom.
The momentum has officially mathematically shifted from the sellers to the buyers.
Okay, and the final step.
Step 4. The actual price action on the chart finally wakes up and reclaims a major historical support zone. This proves that big money is actively stepping in to defend that exact price level.
Man, when you synthesize it like that, it's just a logical story.
It really is.
And I think it's vital for anyone listening to realize that none of this is about finding a holy grail. The RSI isn't a magical amulet that forces the market to give you money.
No, it is just a math formula rendering pixels on a screen.
Well, wait. It's more than just math, though. It's a confluence of evidence.
True.
The RSI dropping under 30 proves the panic. The divergence proves the panic is running out of steam. The trend line break proves the buyers are stepping back onto the battlefield.
And the price reclaiming support proves they brought enough ammunition to win.
Exactly. You aren't trusting a magical line. You are reading a coordinated shift in supply and demand.
And reading that shift is what creates the trader's edge. The indicator is just a tool to see who is actually controlling the market's liquidity, to measure the raw physical strength of the cash flow, and to see clearly how the retail crowd is being manipulated by the sheer visual emotion of price action.
And that is the true value for you, the listener. Whether you're, casually glancing at a stock chart to check on your 401k, or you're deep in the trenches day trading volatile crypto markets.
It applies everywhere.
It does. Understanding these 3 techniques, spotting divergence, reading context over digits, and drawing RSI trend lines, this is how you stop being the liquidity.
Yeah, don't be the liquidity.
Right. This is how you avoid stepping in front of the freight train or selling your assets to an institution right before the price skyrockets. A properly understood RSI, used as an X-ray of market mechanics, is worth infinitely more than dozens of complex, flashy indicators layered on top of each other.
Because you finally move past asking what the market is doing and you start seeing why it is doing it.
You stop looking at the car and you start looking at the engine.
Perfect way to put it.
Well, we started this deep dive by talking about the myth of the easy button. You now have the tools to look past the surface.
Yeah.
But I want to leave you with a final, slightly provocative thought to mull over.
Okay.
We've spent all this time talking about momentum, institutional cash flow, and market maker manipulation. But if an indicator like the RSI is fundamentally driven by overextensions, if it relies on panic, on FOMO, on the sheer exhaustion of a crowd,
Which it does.
right, then how much of trading is actually about mastering the mathematical formulas on a screen, and how much of it is simply about understanding the inevitable, infinitely repeating flaws in human nature?